Stocks to buy March 2022 edition. Yes, folks, we're about to get into 7 stocks that I am planning on buying in March of 2022 and why I'm planning on buying these stocks and why I think they're going to be big money makers for me over the next period of time, essentially. 2 things I want to cover right here at the top before we get into these 7 stocks and why I'm bullish on these 7 stocks particularly. First thing is, whenever I'm doing these videos, always remember I'm a long-term investor, so I'm usually investing in these stocks based upon massive moves I think they're going to make over the next several years. This isn't like a, let me try to get 2% on this stock and then flip it into some other stock. Usually I'm investing in these because I believe I'll double up, triple up, quadruple up my money over the coming years. That's why I'm investing in them. Second thing I want to cover is a lot of folks look at a market that's very, very volatile right now. We had the Russell hit bear market last week. We had the NASDAQ hit bear market last week. And a lot of folks say, why invest in a market that's been downtrending recently? Why invest in a market there's a ton of volatility? And for me, I keep it real simple in the stock market. Here's exactly how I think. If we are in a market that is a bull market, here's what I do. I buy stocks. If we're in a bear market, here's what I do. Buy stocks. If we're in a kangaroo market that's up and down, I buy stocks. If we're in a market that's ultra volatile, I buy stocks. And if we're in a market that is not volatile at all and there's stocks are hardly moving, I buy stocks. At the end of the day, I keep it very, very simple. Do I see great places to put my money for the next 3 to 5 to 7 years? And if I do, and I believe that money is going to double up, triple up, quadruple up over the coming years, then I put my money there. Now, in a market where I see a ton of deals like the market we have right now, I invest more aggressively and I buy more stocks. In a market that things are maybe a little overvalued, I have trouble finding deals. Those ones I invest a little less money. But at the end of the day, I'm a constant investor in the market. I'm constantly looking for the next great stock to buy and to build my position bigger and bigger, increase my ownership position of that company, because whenever you buy underlying shares of a company, you're increasing your ownership stake. And so that's my name of the game. I want to increase my ownership stake bigger and bigger, then make money over the next few years in some of these stocks, go ahead, whenever the time comes out, cash out of that stock, and then go ahead and move that money into the next thing. And so that's the name of the game for me, and it's just always build and build and build. That's what I've been doing for 14 years now, and that's still what I'm doing here in 2022 in March, right? And I'm sure I'll be doing the same exact thing in 14 years from now after that. Alrighty, guys, so let's get into these 7 stocks up here. First one in front of you here is PayPal, PYPL. First one of these 7 stocks, about $110 today for PayPal. And when it comes to these stocks, I actually have a pretty good mix of large cap stocks, mega cap stocks, profitable companies, unprofitable companies, super high growth companies, slower growth companies. There's a mixture of everything in this batch of 7 stocks, okay? But yeah, PayPal recently traded about $128 billion market cap on this one. It's pretty darn close to its 52-week low. 52-week low of 94.50, which was reached a few trading days ago. 52-week high of 310 on this one. PE ratio, this is something that's really attracted me with PayPal recently, is the PE ratio has dropped quite substantially because the stock's dropped so much. The forward P now on the stock is probably, it's under 30 for sure. It's somewhere between the 25 and 30 range now for the stock on a forward P basis. And when I think about PayPal, I think about a company that has the two of the most popular financial apps in all the finance category on iOS, right? In PayPal and Venmo. Those are the two of the most popular. The only thing more popular in those consistently in the finance category is Cash App, which is owned by Square, which is also an opportunity. I don't have that one featured today because I like PayPal a little better on a risk-reward standpoint. But nonetheless, PayPal's a beast company that's just going to continue to get bigger and bigger over the coming years. And you know, it's a big question, like when does PayPal stop growing? And like with PayPal being positioned the way it is and Venmo being positioned the way it is and their revenue growth opportunities over the next 5+ years, I don't see them not growing double digits plus anytime in the next, like, you know, let's call it at least 5 years, okay? Now, when it comes to PayPal, this is a company that is expected to have kind of an off year when it comes to their EPS. They're only expected to do 466 in 2022 when it comes to their EPS. Now, 45 analysts cover this stock. It's a massive stock when it comes to the analyst community. And expectations are low, very, very low for PayPal. And that's kind of a good thing to have low expectations because they could come in with some big beats this year. Now, as far as next year goes, they're expected to get up to $5.83 of EPS. PayPal is one of those companies that I think is a revenue growth beast over the next 5 years, but also they're even bigger than that, in my opinion. Over the next 5 years, they'll increase EPS at even a bigger clip. That'll really start next year. As far as this year goes, 15.8% revenue growth expected, so kind of a slower year for PayPal. Next year, expected to get up to about 20%. So when I look at PayPal, they got 2 dominant apps out there, right, in the financial space. They have a great balance sheet at this company, a phenomenal income statement. They're an EPS story over the coming years. They're a revenue growth story over the coming years. Their valuation story now at their forward P has dropped to about the lowest we've ever seen at in PayPal's history as being a public company. So when I look at all these various factors and think about the expansion coming for this company over the next 3 to 5 years, I'm looking at a stock that's at $110 here today, and it's a steal deal. I'll just put it that way. It's a steal deal, and you don't get this quality of companies that are steal deals very often. You can get smaller cap companies to kind of trade off, and trade down for a period of time. But quality like PayPal, it's very few and far between that you get stocks like this trade this far off of their 52-week highs. And so this is a tremendous opportunity, in my opinion, over the next several years. And this is one I could see myself not just buying in March, but buying for like this entire year, essentially. And especially as long as the stock is under 120 specifically, oh my gosh, okay, that's just stealing money. Even under 150 is extremely attractive to me when it comes to PayPal. Under 200 still attractive. So the further down you get is just the more attractive the pricing is. So yeah, that's first one of these 7 stocks. Let's get into number 2 of these stocks here. Corsair Gaming, CRSR, okay? Corsair Gaming, massive player in the gaming hardware space. Also, huge player now in the hardware streaming space. They own a brand called Elgato, which makes microphones. They make webcams that are pretty darn high quality, and a ton of other products as well, as far as like stream decks and things like that. So this company, it's a P story. So 22 P, forward P of about 15 on this company, about a $2 billion market cap, a business that's very well established, and they just continue to grow and grow and grow the business over time. They came public at kind of the worst time, in my opinion, because they came public when the company was going through a kind of a boom cycle, essentially, right? Where everybody was forced to be home. During that time period, there was a lot of stimulus money out there, but not just that. It was just like everybody being at home. A lot of people had to buy gaming equipment or wanted to buy gaming equipment because they were forced to be home during that time, during Rona. So they went public, in my opinion, at a pretty bad time. Now, all that stuff is lapping off. They've got 1 quarter left to lap off here. And so if we go ahead and we look at the numbers expected for this company in 22 and 23, $1.45 EPS was 2021's numbers, essentially. As far as 22, current year, $1.57 expected. So that's a nice increase there on a year that's supposed to be a down year for the company. Next year, they should get back to very nice EPS growth and do $1.89. 8 analysts cover this. By this time next year, there'll probably be, in my opinion, 10 to 15 analysts that will be covering this stock. It will get more and more attention from Wall Street. This one's big, okay? They're getting in the S&P 600 small caps index, and so that's really big. That puts a kind of a flooring under the stock and just another group of folks that will have to buy the stock, which I really like. As far as the numbers for current quarter, the expectations are pretty horrible. 14.6% down revenue for the March quarter. Expectations just insanely low for this stock. Obviously, this is the last really tough comp quarter they have. And then things just get easier and easier as 2022 goes along. They expect to have a little over 5% revenue growth this year. The company's guided from anywhere from 0% growth to 10% growth. So companies expect about 5%. I think they're leaving a little room to the upside there. Let's put it that way. Never mind if we can, see CPU and GPU supply get out there a little more and a little bit of a healthier place, which we're seeing some glimpses of that. Let's hope that continues on. Next year, expect to get back to 12+% growth. This is a company that should be able to grow double digits year in and year out for the coming years. They just had this huge boom cycle that made their growth get way out of whack and look way better than it was. And now they have that coming off, and so it's made their growth look way worse than what it should really be, right? So now in 23, the growth environment normalizes for this company, and they should get back to a consistent double-digit revenue growth company with, in my opinion, they'll have a stronger growth EPS. They've had a lot of things holding back the business on the EPS side recently. All those things are going from headwinds for the company to actually tailwinds that will push up profitability actually much more rapidly. So Corsair Gaming, love that one. That's why it's a number 2 of these 7 stocks. Let's get a number 3 of these 7 stocks up here, and that is the HONST company, HNST. Let me be very clear. I cannot find a better risk-reward stock in the entire stock market over the next 3 years than the HONST company. I cannot find one better risk-reward. Risk-reward meaning, what are the chances I lose money on the stock over the next 3 years versus the chances I double up, triple up, quadruple up my money in the stock over the next 3 years? I cannot find a more attractive stock right now in this market. It's about a $500 million market cap right now, which is right around, I think, the smallest market cap of all these stocks. It hit a 52-week low of 503, 52-week high of 2388. They went public at the worst time, right at the end of the retail cycle, essentially, which just, it just couldn't find a floor, essentially. And so it's finally found a floor in the fives. But this is one I'm building into aggressively right now, into a big position. And I don't see myself not buying this stock anytime soon, because this one's just, it's... Like I said, I cannot find a better risk-reward play. They make diapers, baby wipes, makeup products, soaps, shampoos. I understand it's not the most exciting business model you ever heard of in your life, but it's pretty darn simple to understand. And all their competitors have basically said they're going to take pricing this year. And so HONST can either take pricing if they want, or they can continue to take market share, which they've been very successful at taking market share from their competitors. So yeah, they're just in a great spot there. They're clicking on all cylinders. As far as 21 goes, a 40-cent loss expected. In 22, they're expected to get very, very close to profitability. Now, something I've consistently seen throughout time is as a company gets very, very close to profitability, they see their stock price go up quite rapidly, because everybody's like, oh my gosh, they're about to flip to profitability. And then when they actually do it and they flip to profitability, you see the next big move for a stock price. I've seen it time and time again with stock after stock, especially when it's a beaten down dog stock like HONST is. And so when I look at this company, it's just... the world is there, so let's just put it that way. Double-digit revenue growth expected for this company. 9 analysts already cover it. Think about that. It's only a $500 million market cap today. Already 9 analysts cover this stock. 13% plus revenue growth expected in 22. This is a stock that's just beaten down. It couldn't find its shareholder base. It will find its shareholder base over the next couple of years. And this is one of those stocks that, I think we'll look back in a few years from now and be like, remember when HONST was $5 a share? It reminds me a lot of Elf Beauty, back when I bought Elf Beauty for about $7 a share several years ago. And Elf is, usually a $20, $30 stock nowadays. Reminds me a lot of that. But this one's actually even more attractive on the upside, and I think has less downside risk than Elf did back in the day when I was buying that one. So take that as some food for thought there. Huge opportunity in this one. I cannot find a better risk reward, and that's why it's just another one of those stocks I'm buying. And this is one of those that I could continue to buy for probably this entire year. Let's get to number 4 of these 7 stocks up here. Let me know what you guys are thinking about these. Any stocks to buy, stocks to watch. Let me hear from you guys in that comment section as always. FB, Meta Platforms. Yes, $208 here today. A little over a $500 billion market cap on this one. P/E ratio is silly. A 15 P/E ratio on this company is just ridiculous. If you didn't know, this company obviously owns Facebook, they own Instagram, they own WhatsApp, they own Messenger, they own Oculus, and they're of the big tech companies. They're in the best position to capitalize on the metaverse, which essentially behind the scenes, what's going on right now is a total war between the big tech Goliath. And I just got to speak on this for a moment here, okay? There's a big war going on in Silicon Valley between the big tech companies. And Apple's tried to attack FB and hurt their business model in the short term. Google's trying to do the same thing. And FB is attacking back by stealing a lot of the best employees for a lot of the big tech companies. And I know some folks that are pretty high up there. And let's just put it this way. Meta is paying a lot more for folks than other companies are paying. And Meta is basically stealing away a lot of the top talent because Meta understands how big the metaverse opportunity is. And they're trying to steal away everybody in sight that is a top person for a lot of the other big tech companies. So there's a total war going on right now between Meta and a lot of the other biggest guys out there. And I can tell you, there's a reason it's going on. There's a reason it's going on, and that's because what's up for stake in this next opportunity over the next 5 to 10 years is so large that Apple knows how big it is, Google knows how big it is, and Facebook knows how big it is. And Facebook is clearly in the lead in this from everything I've done research in regards to this. And I know, like I said, I know people in this industry that I can't really speak on it, but I could tell you FB's in the lead by a mile. And they're stealing away a lot of people, and they don't care about short-term profitability, which Apple and Google do care about short-term profitability. Meta's kind of taking the approach that, we don't care. We're going to spend as much as it costs. We'll spend as much as we possibly need to spend so we can win this battle, because they understand how big it is, and they understand how big it will be for them to have their own platform, which is something they've never been able to have in their company's history. They were really built on the back of the Google Play Store and built on the back of the Apple iOS Store, which all of a sudden those companies can change this and that, and next thing you know, your business is hurt in a major, major way. And so I can tell you, whew, this one isn't just, don't view it as, in my opinion, the wrong way to view this company is just thinking about it in terms of their massive advertising business or massive social networks. That's just kind of the Trojan horse. Let's just put it that way compared to what's going to be happening in future years here. Now, if we want to talk about the shorter term numbers, I mean, they're still very, very healthy, right? EPS expected to be down this year. Very low expectations. 51 analysts cover the stock, by the way, which is just an insane number. That's obviously because they're spending just crazy amounts of money on the metaverse. Like when you see the numbers, it's we're talking 11 figures. We're talking 11 figures they're spending on metaverse opportunity, which is just it just tells you how big that opportunity is. So 1252 expected EPS this year. Next year in 2023 expected to do 1470. They should get back on the right track EPS wise. That's while spending crazy amounts of money in the metaverse opportunity. And that's, that won't even really drive numbers for 5-7 years in terms of big numbers. They're going to continue to grow that business. But in terms of like getting to the big numbers, we're still 5-10 years off of like, wow, they're doing crazy numbers because it's business. Okay. Now, 12.5% revenue growth expected for this company in 22. Expected to have a reacceleration of growth in 23 to 17%. They got some tough comps this year to hit, essentially, and they have the whole iOS changes that's kind of obviously hurt them in the short term there. So Meta, in my opinion, is an extremely attractive play. Really, if you got like a 5 to 10 year outlook specifically, I mean, the stock's massively undervalued, even if you're looking at it from a short-term basis, but based upon everything I understand about this industry, my gosh, okay, the opportunity in front of this company is immense. And I'm telling you, when they're stealing away the top talent from these other companies, it's a no joke as holy smokers. There's a lot going on behind the scenes that no one really gets to see unless you're really, really into this industry and really into on the up and up on what's going on with big tech companies out there. So yeah. FB loved that one. Next one up here, number 5, is The Chef. We knew The Chef was going to be on here. Yeah, The Chef is another stock I'm planning on buying this upcoming month, March of 2022. When I look at The Chef, obviously the earnings should come out at some point here in March, under $1 billion market cap right now, which is just a value I love for The Chef. I speak about The Chef a lot, so I feel like I don't need to really tell the story too much. It's a huge growing industry. It's the most innovative company I've ever seen by a mile in the food industry. They're getting into every single retailer you possibly want to get into. Their SKU expansion is massive in every single retailer out there. Their sell-through is ridiculous. They're getting into new product categories, and I've never seen a company in the food and drink space keep the pedal to the metal like I have when it comes to The Chef. They don't rest for a second over there. And Sam, the one that leads this company, he's leading a company that's a revenue beast. But do keep in mind, he comes from back in the day when he ran private businesses that were very profitable companies, right? He will get this company into great margins and to great profitability over the coming years. They just have to worry about getting their revenues up as much as possible, why they have this huge opportunity for themselves to establish a massive brand in the food space, where Chef is going to go from no one ever heard of this company 2 years ago. No one ever heard of Tattoo Chef 2 years ago to, in my opinion, 2 years from now, I think like half of Americans will have heard of Tattoo Chef because the brand's going to be that famous and it's going to be that in your face at every single store you go into. And you go into a lot of these super Target stores, especially out here on the West Coast now. My gosh, I mean, we're talking about they've got several doors. They've got, 20, 30 SKUs in a lot of these Target stores now. That's coming across the nation, and that's coming across, all grocery stores over the coming years, in my opinion. When it comes to Chef, they're not going to be profitable in 22, or they shouldn't be profitable, but they're going to get much, much closer to profitability, which remember, when you start flirting with getting closer and closer to profitability, you usually see quite a ramp up in your stock price. As far as numbers go, I think they're actually pretty darn conservative. There's only 3 analysts that cover the stock. 29% growth expected in the last quarter. As far as an upcoming quarter, about 29% again, and 32% growth expected in 22. Okay, now, for just about any other food company in the world, especially any other public food company, 32% growth would be outstanding. But I think that's actually a little bit of a lowball number. I wouldn't be surprised if they actually come in with a nice beat there and get very, very, I think as the year transpires and goes along, I think they'll get closer and closer to profitability and actually start posting profitable quarters in 2023, which, if you're talking about taking down the wall of worry around the Chef, they need to obviously do this earnings call on time and not miss the earnings day or something like that, right? If you want to take down the wall of worry, get closer and closer to profitability. If you want to take down the wall of worry more, get your margins more and more in shape as the year transpires this year and in a better and better place. And if you want to take down the wall of worry, keep up that revenue growth. If they do those sorts of things, the wall of worry starts to get destroyed around the chef brick by brick by brick. And this is one of those stocks that, if, for somebody like me, like there's no price I'm willing to sell the chef at. It doesn't matter if it goes up to $15, $20, $25, $30. It doesn't matter what the stock goes to, because when I look at this company, I see a company that's on the trajectory to becoming a food giant, and there's just no doubt in my mind, and there's no doubt in my mind that it's going to become a food giant over the coming years. And so when you're talking about that sort of opportunity, I'm not willing to jump out of this stock because, it goes up a little bit or something like that, okay? Next stock up here, number 6 of the bunch, is Dropbox, DBX. So Dropbox is a cloud company. They also have e-signing and documents business and a few other businesses as well. Their cloud business is extremely sticky, no customer concentration. Company's trading around an $8.6 billion valuation recently. As far as market cap goes, I really like Dropbox. It's not the best revenue growth opportunity out there, certainly in the market. A lot of these companies are massive growth beasts. Dropbox isn't that type of company. It's more for a valuation play and a safety play. I view Dropbox as almost like I would view a dividend stock, where it's just ultra safe in my opinion, especially at $22 a share. So a forward P of under 15. This company should be trading at somewhere between a forward P of 25 and 35 ultimately. They kind of get the treatment that Apple used to get back in the day when folks were like, oh, I don't know how sustainable, iPhone sales are. Maybe somebody just jumps to other smartphones, and then we started to realize, oh no, that's really sticky business model. Dropbox has an incredibly sticky business model. This is one of those businesses that the folks that are their customers just continue to use them year in, year out, have their revenue recur over and over again. And so it's a beautiful business model with almost no customer concentration. You very rarely find that. And so when Wall Street really picks up on how sustainable this business model really is, they will command a much higher forward PE. I could even see a day when Dropbox ultimately becomes a dividend stock as well, which would be huge because then they'll attract the dividend investor crowd as well over. And I see this being one of those companies that ends up getting into the S&P 500 and becomes kind of like a smaller staple stock, where a lot of folks look at it and they're like, hey, yeah, you're not going to get crazy revenue growth, maybe 5 to 10% per year, but it's just a solid company that continues to grow their business, has great customer retention, and ultimately should command a premium valuation based upon where the market's at. So I really, really, really like Dropbox, especially right now at anything 22 or under. That's really, really attractive for me. All right, guys, last one up here of these 7 stocks is Smile Direct Club, STC. This is the riskiest stock of the bunch that we're talking about here, STC. But what I will say about STC is trading at $2 a share, just above $2 a share. This stock has so much bad news priced into it, it's ridiculous. And when you start talking about a stock that's priced at $2, you're basically being priced for bankruptcy. All Smile Direct Club has to do over this next 2 years is they just have to continue to hopefully have revenue grow just a little bit each year. They've got to get closer and closer to profitability, have the losses become less and less, and not go bankrupt. And if they can do that, the stock will make some absolutely epic moves to the upside. And then after they get out of that cycle over the next 12 to 24 months, then they can worry about growing the business again, increasing it. They've just been in a kind of a tough spot the last couple of years because, with everybody being at home, even school, being virtual and those things for most folks around the world, that's not a great thing when you sell a product that is basically clear aligners, right? To fix your teeth. And if you're talking about people working from home, not as much physical interaction in person, that's just not a good thing for a company like Smile Direct Club. So I think this is a company that's going to be poised for a lot of growth over the next several years. And I think I have faith in the management team. It's a turnaround play that they're going to be able to get closer and closer to profitability as the next 2 years transpire, and quarter after quarter, they'll make progress quarter in and quarter out. They've already made a lot of moves there that are putting themselves on the right track to get to that place where they're not taking these ridiculously epic losses, okay? As far as the company goes, expect to lose 66 cents a share in 22, which is a big number. When you're a $2 stock though, if they can just come in a little better than that, you could get a massive move up in the stock. 30% plus revenue expected to decline in current quarter, and 27 to 28% next quarter as well. So expectations insanely low for this particular stock. Like I said, it's a riskier play because of their massive losses they've been taking. But my gosh, as long as they don't go bankrupt, like literally as long as they don't go bankrupt, this one has so much upside. over the next 2 to 3 years. It's ridiculous. It's the most upside of any stock I mentioned in this list. This one has the most upside, but it also is the riskiest play. And that's what you're going to find many times in the stock market. The more risky a stock is, a lot of times the more reward potential there is in a particular stock. And that's definitely STC here. And if the story can just go from horrible to just like a little bad, they're going to see a massive move up in the stock price. If they can go from a little bad to decent, the stock price will see a great move up. And if it can go from decent to great, then we know what happens as well, okay? Hope you guys enjoyed this video. As always, I got an absolutely free course for you down there as a pinned comment at Stock Market Investing Mastery. It's an 11-part course I put together that goes into a lot of what I look for in stocks, and that's a great beginner course. If you're somebody that's been investing in the market for less than 2 years, it's a great free course for you. So definitely check out that as pinned comment. I feel like there's a type of market when folks should get more educated out there. So yeah, much love as always. Make sure to subscribe to the channel. All we do is talk about stocks. I'm buying stuff like that all the time and what's going on in the markets. Much love and have a great day.